Hey, welcome to The Explainer. Today, we're diving into the securities market. Now, this might sound super complex, but really, at its heart, it has one simple, crucial job: connecting people who have spare money with people and companies who have big ideas. Think of it as the ultimate financial matchmaker, just fueling all kinds of innovation and growth. I mean, think about it like this. On one side, you've got folks with some extra cash, savings that are kind of just sitting there. And on the other side, you've got companies, entrepreneurs, even governments who have these incredible, productive ideas, but they need capital to get them off the ground. So, how do you bring these two groups together? Well, that's exactly where the securities market comes in. It's the bridge. It provides the channels to turn all that idle saving into active investment. This is what lets capital flow from those who have it to those who can actually put it to amazing use, funding everything from a brand new factory to a world-changing tech startup or even massive government infrastructure projects. Okay, so here's what we're going to cover. We've just talked about the whole great money matchmaker idea. Next up, we're going to meet the key market players. Then we'll crack open the investor's toolkit and explore tools for ownership, tools for making loans, and some really cool hybrids. And finally, we'll figure out how to take the market's temperature. All right, so first things first. Who are the actual people and groups in this giant financial world? Let's take a look at the key players in this whole ecosystem. It really boils down to four core groups that are in this constant dance with each other. First, you've got the borrowers, like companies, who need cash and sell securities to get it. Then you have the investors, who buy those securities and provide the cash. In the middle, you have intermediaries, think stock exchanges, that act as the marketplace where they can meet. And kind of watching over the whole thing are the regulatory bodies, who are like the referees making sure the game is played fair and square. Okay, now for the fun part. Let's crack open that investor's toolkit. The first, and maybe the most powerful idea we're going to look at is ownership, how you can get a literal piece of the action. So right at the top, you've got this one big choice to make. You can either buy equity, which means you become a part owner and you get to share in the company's fortunes, both the good and the bad, or you can provide debt, which is really just like giving a loan in exchange for a fixed, predictable return. Let's dig into equity first. So the classic way to do this is with an equity share. When you buy a share, you are literally buying a tiny, tiny piece of that company. And the key thing to get is that you're in the same boat as the founders. If the company takes off and soars, your investment can too. But if it struggles, well, you bear that risk right alongside them. And this table here, it really breaks down the whole ecosystem for us. Companies are the ones who issue the shares to raise capital. Investors, everyone from giant institutions like pension funds all the way down to individuals, are the ones who buy them. And crucially, you have a regulator, in this case SEBI, India's market watchdog, setting all the rules. It creates this whole system of creation, consumption, and oversight to protect everyone involved. But what if you don't want to spend all your time picking individual company shares? That's where mutual funds come in. They are these incredible vehicles that pool money from thousands of investors and then use it to buy a whole basket of different securities. It's basically like buying a ready-made portfolio, all in one go. And you'll see a pretty similar setup here for mutual funds. They're issued by specialized fund companies and bought by all sorts of investors. But notice the regulators here. It includes both SEBI and the RBI, India's central bank. And that's because these funds are dealing with such huge pools of money and a wide variety of assets. So they need really tight oversight from a couple of different angles. All right, so we've talked about being an owner. Let's flip the coin. What if you just want to act like the bank and lend out your money? Well, for that, we've got instruments like debentures and bonds. And yeah, you can pretty much think of these as official IOUs. An organization borrows your money, and in return, they promise to pay you regular interest and then give you your original money back on a specific date in the future. It's a loan, plain and simple. Now, what's really interesting here is who is issuing these things. It's not just companies. Governments issue bonds to fund things like highways and schools, and even special purpose vehicles, or SPVs, which are basically just little companies created for a single project, use them too. This variety just opens up a huge range of lending options, and it's all overseen by regulators like the RBI and SEBI. So we've got ownership on one side, loans on the other. But what if you could mash them together? The financial world gets pretty creative, and that's led to some really fascinating hybrid tools that try to give investors the best of both worlds. A classic example is the preference share. And just like the name says, these shareholders get preferential treatment. They get paid their dividends before the common shareholders get anything. And if the company ever gets wound up, they're first in line to get their capital back too. And this is why we call it a hybrid. On one hand, they're like equity because you are an owner and you're getting dividends. But on the other hand, they're kind of like debt because that dividend is often a fixed rate and you have priority. You're first in line to get paid back if things go south. This gives you a bit more safety and predictability, which can really reduce your risk compared to a regular shareholder. Okay, another really cool hybrid is the convertible debenture. This thing starts its life as a simple loan, a debt instrument, but it holds this special power, the ability to transform into equity shares at a later date. So let's follow the life of one of these things. It starts out as a safe loan, where you, the investor, get regular interest payments. But then comes the conversion option. If the company does really well and its stock price takes off, you can convert your loan into ownership at a price you already agreed on. You get the safety of a loan up front with the potential upside of an owner later on. Pretty clever, right? So, we've seen the players, we've seen the tools in the toolkit, but with literally thousands of securities trading every single second, how do we get a sense of how the market is doing overall? How do we take its temperature? We do it with a market index. Really, an index is just a scorecard. It takes a representative sample of shares, like the 30 big stocks in the Sensex or the 50 in the Nifty, and it combines their prices into a single number. That number gives us a quick snapshot of the market's overall direction. Right, so this index, it's not just some random number on a screen. It's a seriously useful tool. You use it as a benchmark to see if your own investments are doing well. Economists watch it like a barometer for the country's economic health. And day to day, it captures market sentiment. A rising index generally means investors are feeling optimistic. So, when you pull it all together, what you see is that the securities market isn't just one thing. It's this incredibly diverse and dynamic toolkit. Whether your goal is to be a part owner, a lender, or even something in between, there's a specific tool designed to help you get there. Understanding these tools, the equity, the debt, the hybrids, that's the first step. They're the fundamental building blocks of investment portfolios and financial futures. The real question is, now that you know the tools, what will you build? Thanks for joining us on The Explainer.